What sounds better, a 40% tax or a 20% tax? Stupid question, right? Well, stay tuned and I'll show you how to legally minimize taxes when you're looking to sell your business. Hey everyone, I'm Michael McGregor and I'm an M&A investment banker with Focus Investment Banking. And I'm part of a team that helps retail tire dealers, commercial tire dealers, and tire wholesalers with mergers and acquisitions. But I'm also a monthly columnist for Modern Tire Dealer. In last month's column, I addressed the proposed tax changes that are on the horizon. And since this is for the April edition, I thought I'd continue with the tax theme and discuss how transaction structure can impact your net after-tax proceeds when you're looking to sell your business. After reading my column, you'll know the difference between an asset sale and a stock sale, so you can choose the best transaction structure for your form of organization. We've helped our clients save millions in taxes by choosing the best structure, so I think you'll find this column and this video helpful. But before we begin, please subscribe to my YouTube channel and click on the notification bell so you know when I have new videos. And if you want, please email me your email address separately so I can add you to my monthly newsletter. So let's start by examining the capital gains impact of transaction structure. In the automotive business, most transactions are done as asset transactions or as stock transactions. In an asset sale or transaction, a buyer is essentially buying all of your assets, and that could be your equipment, your inventory, your goodwill, your brand name, the fact that you have customers, they're buying all that. And in a stock transaction, they are buying shares in a corporation, and the corporation could be a C corporation or an LLC. Now, most of the time, buyers prefer asset transactions because they know exactly what they're buying and what they're not buying. And in a stock transaction, there's potential that they could be acquiring what are called hidden liabilities because you've been in business, say 50 years, and you're a C corporation, right? It could be some environmental issues, some lawsuits that they didn't know about. Those are hidden liabilities that make people kind of nervous about acquiring stock. Also, there's some depreciation angles to acquiring stock that are not as beneficial to some as asset transactions. Nevertheless, we do both. We do asset transactions and we do stock transactions. Now, the major difference is involving an asset transaction. And it really has to do with the fact that in a C corporation, okay, who owns the assets in the C corporation? Well, essentially the corporation owns those assets. The corporation owns the inventory, they own the equipment, and they own the goodwill essentially. And you're the shareholder that owns shares in that C corporation. But for other entities, whether it's an LLC, an S corporation, a partnership, or a sole proprietorship, effectively the owners of those businesses own those assets. Well, let's examine the capital gains impact of transaction structure. And this really matters most when the seller is a C corporation. And in my column, I give a side-by-side example of a C corporation selling assets versus selling the stock. And the example starts with, well, say the price is $10 million or that's the gain. So if a corporation is selling assets, well, the money flows into the company and they're going to pay a corporate tax on that, about 21%, right? Now, how do you as a shareholder get your hands on that money that's in the company? You have to pay a dividend, which again, there's a dividend tax on top of that corporate tax you just paid. And that should be about 20% plus 3.8% net investment income tax credit on top of that, or net investment income tax on top of that. Long story short, asset sale in a C corporation, you end up paying as much as 40% total tax. Versus a stock sale of that C corporation, you're just going to be taxed once because you'll sell the stock and you'll just pay a capital gains on the sale of that stock, which is currently at 20% plus again a 3.8% net investment income tax. So clearly in a C corporation, it's more beneficial to the shareholder to be involved in a stock transaction and to sell the shares versus an asset transaction, because I think in my example I show that you'll save up to 1.6 million. Now there's other things that you could do to kind of minimize the impact of an asset sale in the C corporation, and that's involved things like personal goodwill, and that's why you use tax advisors and investment bankers to help you structure this stuff, right? I next give an example in my column as to an asset or stock transaction when it's a pass-through entity, whether it's an LLC, S corporation, or a partnership. And the upshot is there's no difference there, so it doesn't matter. And effectively is because the owners of those organizations are treated as if they own those assets or own the stock themselves, so they're only taxed once. It's also important to note, if you are involved in managing that pass-through entity, you probably also avoid the net investment income tax of an additional 3.8%. Now, I may have mentioned earlier that there's certain things that you could do to minimize the taxes in an asset sale in a C corporation. They have to do with purchase price allocation and the sale of personal goodwill by the owner of that business separately in that transaction. But things like that are why you hire investment bankers and tax advisors to help you with that stuff. In many transactions, an earnout is used to bridge the gap between what an owner wants for the business and what a buyer is willing to pay. And earnouts are usually tied to achievable targets of revenue or EBITDA, and they're only paid if and when those things happen. So with regards to taxes, it's important to note there's a basic principle that goes, you're only taxed on what you actually receive. So if you negotiate a transaction for like 85% of the purchase price is going to be cash, and then there's going to be a 15% earnout, you should know you're not going to be taxed on that earnout until if and when you receive it. And you should also know that that will be deemed as long-term capital gains at the time because you negotiated at the time of the sale. In other transactions that we've seen, like particularly in a structured sale transaction, here's a tax implication of that. In a structured sale, you have a key trusted employee like a store manager, and that manager goes out and comes up with a down payment for the purchase price for the business that you both agree on. The rest of it is paid over time. You should know that those payments over time are taxed at long-term capital gains. Let's see what else is involved in taxes. Well, in a lot of deals we're involved in, there's employment agreements or consulting agreements. If you're paid on those agreements, you should know that those will most likely be at ordinary income taxes. So in sum, transaction structure definitely affects the taxes that you'll pay. Planning ahead and hiring trusted advisors will help you minimize those taxes. So I hope you found this video helpful. If you have any questions, please call me at 704-369-5900, or you can email me at michael.mcgregor@focusbankers.com. Thanks for watching, and thanks for being a loyal Modern Tire Dealer reader.